Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at the top 3 companies in the Dow Jones Industrial Average that Wall Street analysts have a strong buy rating on at this current point in time. And the Dow is one of 3 main indices that tracks the performance of the overall American stock market. Of course, we have the S&P 500, the NASDAQ, and commonly the third is the Dow Jones. And this is a very unique index. It's made up of only 30 large cap publicly traded American companies, and this is a price weighted index, meaning the actual price of the Dow, which currently trades for just below 34,000, is an average price of all 30 of its holdings. This is very different because most major indices all around the world are market cap based. Like the S&P 500, it's determined on the ranking of each company within the index by the actual market cap of the underlying business. Meanwhile, the Dow is a price-weighted index, so it's completely different and a very interesting concept, but it's been adapted to our society and our market for over 3 decades. So in this video, we're going to take a look at the top 3 companies and actually the bottom 3 in terms of analyst rating at this current point in time. So I found an interesting article that lists all 30 Dow companies from worst to best in terms of the ranking they have from Wall Street analysts at this current point in time. And coming in at number 30, or the stock that analysts have a hold on right now, we have ticker WBA, which is Walgreens Boots Alliance. Then coming in at 29th, also with a hold rating, we have 3M. And coming in at number 28 and rounding out the bottom 3, we have Travelers. So these 3 companies have the lowest buy rating in terms of Wall Street analysts at this current point in time, and they're all considered a hold at their current price level. In this video, we're going to take a look at the top 3 companies in the Dow that are all considered a strong buy, even at this current point in time. A lot of these companies have seen a massive run up as of late, but Wall Street analysts do believe now is an excellent opportunity to buy these strong blue chip companies that will continue to generate revenue and cash flow for many years to come. And before we take a look at stock number 3 in the index, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course today we have a very interesting video going over the top 3 companies ranked by Wall Street analysts within the Dow Jones Industrial Average. And coming in at number 3, the first company we're going to take a closer look at today, we have ticker DIS, which is Walt Disney. We all know this company, one of the biggest, baddest consumer and entertainment brands in the world. They have global operations, an unbelievable suite of different products, and with Disney Plus taking over the streaming world, even throughout the 2020 pandemic, which shut down their theme parks, Disney still performed very well. And we can see by taking a look at the stock chart, the company currently trades for $174 per share, and they're up by 45% on the 12-month chart. They have a market cap at $313 billion, and because their earnings did suffer throughout 2020 with the closure of their theme parks, which are really a cash cow generating activity for the business, their forward PE ratio does sit around 72, which is high at this current point in time. But taking a look at the company, right now there's a lot of good things going on. And the launch of their Disney Plus subscription service was an incredible success, and they achieved 100 million paying subscribers in less than 16 months. And going forward, I think this platform will continue to grow year after year. I think every single quarter they're going to gain more subscribers, and I do think this can be a major rival to Netflix over the next 5-year timeline. And with Disney Plus, I think they've done a great job of releasing new content on the platform, and the company shifted their overall focus of the business to actually make exclusive content directly for Disney Plus subscribers, which is a great sign. And of course, another very, very positive thing for this business is the fact that now every Disney theme park all around the world is open for the first time in 17 months. For 17 months, there was not a single day where every single theme park was open and operational at the same point in time. So now Disney worldwide will be generating revenue and income from all their different theme parks, which is absolutely remarkable. And I'm expecting over the next 3 to 4 quarters, the company's bottom line will absolutely explode once we start to recognize the impact that the reopening of the theme parks has on the underlying business. So I think this is a major sign for Disney. All their European and Asian theme parks have reopened as well, and the company is doing a bunch of great things at this current point in time. And if we take a look at the income statement, although 2020, we did see a decline in overall revenue from $69 billion at year end 2019 down to 65, and in the trailing 12 months, they've only generated $58 billion of total revenue. Going forward, analysts are very, very bullish on this total sales number. They're expecting that over the next 5 years, Disney can achieve over $100 billion in annual revenue. And I think if that does happen, the company will be worth a lot more than where they currently sit today. And if we jump over to the article that actually ranks them as the number 3 company in the Dow Jones at this current point in time, they have an average analyst rating at a 1.59, which represents a buy. And this score is based on a scale between 1 and 5. If the company is ranked between a 4 and a 5, analysts believe it's a sell or a strong sell. If you're coming in the middle around a 3, that puts it as a hold, and anywhere between 1 and 2 are the lower end of the scale. That means it's a buy or a strong buy from the average Wall Street analyst prediction. And we can see for Disney, 16 analysts ranked the company as a strong buy, 6 were a buy, and 5 were a hold, and no one was selling out of this company at this current point in time. And they're forecasting annual earnings per share growth of more than 23% for the next 3 to 5 years. So like I mentioned, now that the cash cow operating activities, like the actual cruise lines and the different theme parks are going to be reopening very soon, they're expecting the bottom line of the company to explode going forward by 23% over the next 3 to 5 years, which would be absolutely remarkable and could lead to some extended growth in Disney's share price over that same timeline. So Disney is currently the company in the Dow Jones with the 3rd highest buy rating at this current point in time. And now if we transition into stock number 2, it's going to be ticker UNH, which is United Health Group, one of the largest healthcare companies within the United States. They are currently ranked as the 2nd strongest buy within the Dow Jones at this current point in time. And if we take a look at the company, they're trading for just below $400 per share, and they've grown by over 33% on the 12-month chart. They're worth $367 billion, trading with what I believe to be a very reasonable forward PE ratio, right around 21, and a nice dividend yield at 1.5%. And over the long term, this company has seen incredible performance, growing by 182% on the 5-year chart, and over the past decade, up by close to 680%, so it's proven to be a great long-term hold within a dividend growth portfolio. And taking a look at their income statement, year after year, they continue to generate more and more revenue, which is absolutely phenomenal. We can see from $184 billion of total revenue up to 201, 226, 242, 257, and now in the trailing 12 months, just below $263 billion of total revenue, which is a great sign. And of course, this is a dividend paying company with a yield on the lower end of around 1.5%, but their payout ratio is extremely sustainable, making up only 31% of their net income, and their dividend CAGR is absolutely insane. Their 5-year dividend growth rate is at 19.6%, meaning your smaller dividend to start out with is compounding and growing at an insane rate year after year after year. And when you buy a company like UNH, this dividend, I believe, is pretty much like an added bonus to the large share price appreciation you're going to see every single year as well. And if we jump over to the article, this company currently has a rating at a 1.58, which makes it a buy as well. And as the largest health insurer, both in market value and revenue within the United States, this company is poised to see long-term growth because they provide a service that will always be in demand. And currently, this article talks about how the valuation on the company at this current level is very reasonable when compared to the S&P 500, which is trading at a sky-high level compared to its historical average as well. And right now, they're forecasting annual earnings per share growth over the next 3 to 5 years of 14%. So even for a mega cap company worth over $350 billion, one of the leading healthcare brands in the world, they still believe they can grow their bottom line by 14 to 15% for the next few years going forward. And again, similar to Disney, if these expectations do come true, I do believe UNH will continue to grow and perform very well while providing a fast-growing dividend to shareholders over the longer term, and they are currently the 2nd company in the Dow with the highest buy rating of a 1.58. And now we're going to move on to the 3rd and final company in today's video. This is the number 1 stock within the Dow Jones Industrial Average, which is made up of 30 blue chip American companies. It has the strongest buy rating at this current point in time, and it is Microsoft. The 2nd largest company in the world is currently considered the number 1 buy out of the 30 companies in the Dow with a rating of a 1.33, which is considered a strong buy. It's only the second largest company in the world, just behind Apple, and because of their different products, their different software services, and the growth of their cloud business, this company is expected to see incredible growth over the longer term. And right now, 27 analysts have Microsoft at a strong buy, 11 have them at a buy, and only one single person has it as a hold, and no one is selling out of this company. And taking a look, ticker MSFT trades for $263 per share. They're up by 32% on the 1-year chart, and they currently have a market cap at $1.95 trillion. Their forward PE ratio is sitting at 33, which is higher than the overall market, but when you're getting such a solid company like Microsoft, I personally am okay with paying a higher premium. And the current dividend yield is tiny at only 0.86%, but this company does a ton of share buybacks every single year, and they grow that payment at a fast rate, so the overall cash return to investors currently sits between 3 to 5% on an annualized basis if including share buybacks. And we can see that the total revenue for this business continues to grow every single year, no matter what. $91 billion of total revenue back in 2016, all the way up to around $160 billion in the past 12 months. And this company's balance sheet is absolutely flawless. They have an incredible amount of cash sitting on the balance sheet right now, so they can do any acquisition they want. They can focus on research and development. They can pay down the little bit of debt still sitting on the balance sheet. And overall, this company as a whole is in a very strong financial position. And in the past 12 months alone, their net income currently sits at $56 billion, and their free cash flow over the same period is at over $50 billion as well, which is absolutely remarkable. And taking a look, they have a yield at 0.85%. Their payout ratio is very tiny, making up only 29% of the company's total net income, and their 5-year dividend CAGR is at 9.5%. And I may be a little bit biased when evaluating Microsoft because I am personally a big bull on this company. It is the number one position in my portfolio. I own 64 shares with a value of $16,860, and I'm up around 29% on my Microsoft position. I do believe in this company long term. I think it's one of the strongest, if not the strongest company in the world. I think their diversified product mix is going to allow them to continue to grow in both the consumer and the commercial space. And over the long term, I'm just a bull in the company. That's as simple as I can put it. I've owned them for many years. It's my number one position, and I plan to even buy more at this current level, although the company currently sits near all-time highs. So taking a look, these were the top 3 companies with the strongest conviction of a buy coming from Wall Street analysts within the Dow Jones Industrial Average. Number 1 was Microsoft, number 2 was United Health Group, and number 3 was Disney. The Dow Jones overall is a very unique index. Of course, like I mentioned at the start of the video, it is price weighted, which is very different from many of the traditional indexes, which are market cap based. So this is an index of the 30 largely owned publicly traded American companies. They provide different services in different sectors, and this index is one of the main ways we track the performance of the overall American stock market, and we can see over the longer term, it has performed extremely well and is up by 94% over the past 5 years, which is a great sign. So overall, the Dow Jones Industrial Average and the top 3 companies ranked as a buy is what we talked about in this video today. So please hit that like button, subscribe for the daily videos, join the community down below, and I will see you in tomorrow's episode.